For 2021 and continuing into 2022, supply dislocations caused used car acquisition prices to rise an unprecedented 40%. Those inflated used vehicle prices, often topping their original MSRP, were largely passed along to customers who had few other options if they wanted a vehicle. And because so many did want those high-priced cars and trucks, dealers posted record profits. However, as 2022 progresses, that value inflation is not likely to continue as new car production comes back online, inventories recover, and customers' willingness to pay starts to fade. Used vehicles, especially those higher-end, nearly new vehicles selling for $35,000 and up that were acquired at inflated prices, will become harder to move without price adjustments. Customers to which high-end vehicles might appeal are also learning to utilize build-to-order options offered by the factories. Some OEMs, like Ford, are offering incentives to customers who order and wait. And if Ford CEO Jim Farley is to be believed, it is here to stay. Stating on the Q2 2021 earnings call with investors, we are really committed to going to an order-based system and keeping inventories at 50 to 60 days supply. I know we are wasting money on incentives. So what's a dealer to do to combat such very real margin compression threats? Ed French, president of Auto Profit, joined us to explore how to manage margin compression in the used vehicle inventory. The full 45-minute recording of this discussion is available to Dealer's Edge members only. To access this workshop, as well as our full library of webinar recordings, executive summaries, books, manuals, and special reports, please visit dealersedge.com/free trial. Bad habits. Because it was too easy to sell regardless of price in 2021, managers and sales staff got sloppy and took their eye off the inventory discipline ball. Ed recommends tightening up inventory acquisition discipline, beginning with these steps. First, start paying attention to loan-to-value, LTV, because lenders are beginning to tighten portfolios as repo rates rise. Second, pay attention to how well vehicles sell in your price bracket. Third, make sure that you have adequate inventory of the milk, bread, and eggs of your vehicle market. These are the types that you are known for example, trucks, Fords, etc. Because they are most in demand, these vehicles should always be on the lot. Fourth, resist buying high market day supply vehicles, even if they look like bargains, because they come with a high risk. Fifth, pay attention to equipment, miles, and color to avoid introducing slow movers into inventory. Sixth, rely on management knowledge about your current market and then use software to make the best decision. Ed went on to cover how to manage your used car inventory to minimize the impact of margin compression from high-cost vehicles. Key performance indicators to help you improve your inventory velocity. What will you measure in 2022? Have pay plans gone out of whack because of used car inflation? And is there a way to adjust them in times like these? In conclusion, while 2022 will not be 2021, it will still be a good year. However, this is a time to begin preparing for 2023 and beyond, as damage from the pandemic heals and before the game of overvalued inventory musical chairs ends. Remember, the full 1-hour streaming video workshop, its corresponding handouts, and executive summary are available to members in the Dealer's Edge archive 24 hours a day. You can sign up for a 30-day free trial and see all we have to offer at dealersedge.com/free trial.